So, good day, Profitable Investor here. In this webinar, I'm going to be sharing with you on lot sizing and risk management 1. In fact, the scope of risk management can take us up to about 5 or 6 episodes. But I'm going to try to summarize everything in this episode so that in subsequent video, we can do a practical demonstration of this using a demo account before we launch into the signal. So what exactly is a lot size? If you have ₦1 million and you give your money to someone to help you trade, and the person says he blew the account, there are many reasons why that could be possible. It's either the person is a thief and did not trade and just took your money away, or the person risked. The person did what? The person risked all the money at once, and the money went haywire. So when the person risks all the money at once, and your money went haywire, there are two things that can happen. It's either the person can lose all the money at once, and if very fortunate, because forex trading is a game of numbers, if the trade goes on very well, in fact, the ₦1 million can become 10 million or even 100 million. That's why you see that in the crypto space, you can buy a crypto asset with $100 or $1,000, and the asset can do 1,000%. And if it goes down, you lose your money too. So that's just the essence. So lot sizing is about how can we take that 1 million, okay, and break it down into smaller units so that by the time we are trading, we can spread our risk. Okay? So I can decide to take that 1 million into 10 places. So it means that for every one trade I take, I'm risking 100,000. All right? I can decide to take it into 1,000 places. All right? So for every trade I take, I'm risking 10,000 naira. All right? I can decide to take it into 1 million places. So for every trade I take, I'm risking 1 naira. That is just the concept. So now, why is this important? It's important because capital size differs. You see people with $10,000, 1,000. But the truth is this, 90% of the people listening to me right now do not have and will not have the capacity, all right, to trade $10,000. $10,000 is 15 million naira. Most people will never have that money to trade. Most people will fall within the range, even with good savings, of $500, $100, $50. In fact, 90% of the percentile will do between $50 and $5. So because of the nature of what we are trading synthetic asset classes. I'm not here to begin to tell you what they mean, okay? All right, and these are the asset classes that we trade, which I'm going to show you on video. We have VIX75, which has its own lot size to be 0.001, boom 500, 0.20, VIX10, as well as A10, has 0.5. So in the next video, I'm going to show you how to calculate this in terms of dollar worth, so that you know, okay, how many points or pips or the value I'm risking will take this minimum lot size. All right, so basically there are 3 approaches as to lot size management. There are 3 approaches as to lot size management. We have the 1 to 2% rule. We have the win-loss rate frequency, and we have a combination of both. So for this signal, I'm going to be combining, I'm going to be playing my field with win rate or loss frequency. And this is very important. Why? Because we are trading a very small capital. Don't forget that as I speak today, $1,000 is 1.5 million. $20 capital is 30,000. So somebody that is trading and has the same win rate as you are, let's say the person has the same 20% win rate as you are, all right? But he's trading a capital of $1,000. The person will make almost times 100 of your own capital. Why? Because of the capital involved. So let's look at, I'm going to consider 3 models. I don't want this video to be more than 10 minutes. I'm going to consider 3 models. And I'm going to look at how we can combine both or which approach to use. This is because some of you listening to me right now are going to be doing this signal with just $20. A few of you have 100, and rarely you have $1,000 capital. So for such people, the lot size you're going to be using is going to be different because of your capital. So let's consider an average, all right, of $50 capital. Now, there's something we call risk to reward. So it means that for every trade we go into, we can either lose or win. That's just the game of the number. But if we win, we want the hedge to be in our favor. If we toss a coin, it is either it's going to fall with the head or with the tail. But we want a situation whereby any time we win is times 3. And if we lose, it's just times 1. So as long as we have relatively more wins than losses, we'll always make money. This is one of the greatest secrets most people don't know, apart from gambling. Okay? So now, we are risking, in this context, of a $50. We are risking $5 per trade to take $15. So if we break $50 by $5, so it means that the maximum number of trades we can take is 10. Some of you may decide to take the 10 trades in a day, some in a week, some in a month. I tell you from experience of over 5 years, if you take the approach of the monthly approach, that is, you are not going to take more than 10 trades in a month, it will filter your trades to the point whereby only highly probable trades you are going to be taking. But if we take the whole 10 trades, I know people that have come to me that says they're not profitable, this and that, and I see their track record, I see their trade history, they take 20 trades in a day, they will never be profitable. They will blow money, they will get into police custody, they will have issues. Even if they make money by gambling or by luck, they will lose it back because it's not sustainable. A week is still relatively dependent on many factors. Somebody that is trading a $500 account can decide to say, okay, I'm not going to be risking more than $50. And he can spread that $50 within 3 to 5 days. All right? So in 5 days of trading, active trading, it may be very good with 2 good trades and 3 bad trades. But the good ones will always outshine the bad ones. So our verdict is that, okay, we consider a win according to our risk management. That is when a trade goes in our direction and gets to the target. That is, if it remains 2% to get to our target and it doesn't get to the target, we will not close the trade, we will not influence it. Likewise, if it's about to hit our stop loss, we will not close it. We will let the trade run on its own without being hindered. So that's why we said unhindered according to risk management. All right? So let's consider these 10 trades. Like I explained earlier on, it can be a result of 1 week, a day, a month. Sometimes it can be even 3 months. If you are trading for an hedge fund and you are giving $1 million or $5 million or $10 million or $100 million, you're not going to be trading like boys that are looking for money. You're going to be trading like a professional manager. So let's imagine this. The first trade, loss -5. Second win, +15. Like I told you, 1 to ratio 3. Third, loss. Fourth, loss. All through this. The analysis in this context is you had a total win of 3 out of 10, and you had a total loss of 7 out of 10. This is very, very probable because you cannot always win and you cannot always lose. In fact, statistics tells us that professional traders have win rates from 40% to about 60%. It usually doesn't go beyond this. All right. So now the capital before trading is $50, and the capital after trading is this should be $60, not even $10, because $10 is the profit. If you do the math, minus 5, minus 5, minus 5, 5, 10, 15, 20, 25, 30, 35. All right. So 1, 2, 3, 4, 5, 6. Yes. So minus 35 plus 45. That is plus 10. So in this season of trading, which can be a day, a week, or a month, the person made $10. While you may say it is very small, that can be the breakthrough somebody is needing. Because if you multiply your capital by 10 or by 100, that's going to be the value you're going to get with this same model. So this person eventually made a profit of 20% return on investment. So imagine it is on a monthly basis, and this person is carefully doing this. All what he just needs to do is just to be patient to get a capital of about $500 or $5,000, and the same result is going to be multiplied by the effectual profitability ratio, which in this context is 20%. Moving forward, that's model 1. This one is very practical. In fact, many times, my win rate may not exceed 30%, and there's nothing to be afraid or shy about. Sometimes you can have the first 3 trades can be loss, loss, loss. Even the 4th one can be loss, and the 5th one can be win. The 6th can be loss, 7th can be win, win, loss, loss, and you still meet your target. So this is the second model. Same approach, but in this context, we are not just being blind to until you get to this point, we close or not. Until you get to that point, we hold or not. So what we are going to do in this context is, in a series of 10 trades, we are going to influence about 30%, that is 3 out of 10. In other words, because it's a game of probability, we don't know which trade would pan out well. That's just the truth. So when you do this, we trade when a setup is going according to our risk management, but we just notice that maybe there's a change of market structure or a break of market structure and things like that. So in that context, it may be influenced by emotions. So what we do is this. Whenever we notice something like that, we just adjust, okay, let me break even, let me close this trade. All right, so in this context, we are saying that, okay, 30% of the trade is going to be influenced, while 70 is not going to be influenced. All right, so in this case, the first one, loss, win, break even. Now, break even in the sense that, okay, the trade has been dilly-dangling around a range for a long time. Maybe you are in a buy setup and you are into negative, then you go into positive, and you are just tired of the setup. You may close it at break even or maybe plus a few cents or minus a few cents. Okay. Now look at this one. Close profits plus 5. So it means that maybe the trade is not going as you planned. Instead of you to wait for it to get to the target of plus 15, and you see that this thing is taking longer than usual. I've been on trades that for 3 days it has been dragging. We will go on a good profit to come back. May not decide to close the trade to avoid emotional torture. Okay, so we have a trade of such, 3 of them like that. Okay, so let's see the result, and then you only notice that only 1 trade out of the whole 10 trades is allowed. I mean, 3 of them, 1, 2, 3, are allowed to run on their own, and out of the 4 of them are allowed to run on their own, and out of the 4, just 1, all right, goes exactly according to plan. So let's see the results therein. All right. So we can see the total win is 1 over 10. Total influence trades, that is those ones that we broke even and we closed the profit. And then you see that the total number of losses is 4 over 10 and all of this. If you do the maths together, you see that, in fact, we even have 30% risk to reward, which is very good. Although the challenge about this approach is, if you have not been training for a long time and you have not focused on maybe 1 or 2 or 3 pairs, it may be very difficult for you to achieve. For example, on currency trading, I only trade gold. I don't trade any other setup. And my results are very, very amazing. Once I make the money, I withdraw. I don't wait to compound all of those things, okay? Now, let's consider the last one. Our time is fast spent. $50. And the goal of this is that when a trade performs unhindered according to risk management, okay, and with 30 to 40% strict win, when it does in this manner, and then if the structure is good, we lock up 1:2 and let the rest run. So for example, 1:2 is, we are risking $5 to get $10. So in a situation whereby we are going to use this approach, it's going to be so that out of 10 trades, just 2 out of 10, okay, are going to look at, okay, if this trade continues to go like this, and we have done about, let's say, the trade has done about 1:2, and it's still going up. So let me say the trade is currently about plus $12 in profit. It remains plus $3 to hit our target. You can just adjust your stop loss to your plus $10 so that even when it reverses, it can only take you out as plus 10. So in this context, we let one run well. 2, 3, 4, 5, 6. So 60%, we let it run. 70, 80. 80% of the whole trade, that's 8 out of 10, we let them run. But 2 out of them, we influence them. Okay? So out of 8, we won just 2. Went into the direction of our profit. Good trade. All right? And the losses, minus 5, minus 5, minus 5. Now, when we now see a setup whereby the potential of that trade setup can give us more than 1:3, what we do many times is not to limit ourselves to just 1:3. Whenever our trade gets to 1:2, sometimes the next strategy we just do is to lock 1:1. So you put your stop loss at 5 and you let the remaining run. By the time it almost gets to your take profit of 1:3, you adjust your take profit to the next high or structural low. If you have been trading for a while, you should understand this. So in this context, sometimes you can get a trade that the potential of the trade even before getting to the trade can give you 1:10, 1:15. I've been on some very strange trades like that. I've been on a trade that gave me from 1:40. So in this case, you can have it maybe 2 times, 20% of the times. And these are the kind of trades I like to wait for. It can take days, sometimes weeks. So in this context, instead of you to do 1:3, which will give you $15 in this case, you can do 1:6, give you $30, and 1:4. When you do the whole math all together, you just won 20%. You had 20% on usual trade and you lost 60%. Yet, you are 50% profitable. That is extremely good. These are very realistic targets that you can set up for yourself and make money for yourself. All right? So in this context, you have about 50% return on your investment. So for about, is it 50% or even 100% now? So your capital is $50. You have made $50 again. That should be 100%, if I'm not mistaken. So in this case, it takes years for you to reach this level. So we're going to be focusing on, because of the capital most people are going to be using. Most people are going to be using capital of $20. which in itself you'll have realized that is not very sustainable. So it means that the kind of trades are going to be looking for setups are going to be trades that we can only risk $3 or less to get $9. We can risk $2 to get $6. And we can do that for a period of a month, depending on how the signal comes, and we should be able to make money. This is one of the most practical way of growing your income on a small scale and on a consistent basis. I hope this really makes sense to you. All right, guys, cheers and God bless you.